Why do most people fail in investing even when they have access to all the information in the world? And why does the stock market gives great returns, but most investors still lose money? Hello everyone. Today we are going to understand key ideas from the book Value Investing and Behavioral Finance by Parikh. This book shows that investing success depends more on behavior than knowledge. Let's start with the first slide. Why investors fail. The author explains that most people fail not because they lack intelligence, but because they lack discipline. Even with unlimited knowledge available today, people choose what is easy instead of what is necessary. Habits play a big role here. Once formed, they are difficult to change even if they lead to poor results. The author also explains six traits of human nature: laziness, greed, ambition, self interest, ignorance, and vanity. In investing, these traits affects our decisions. Greed makes us chase quick profits, fear makes us sell at the wrong time, and vanity makes us follow the crowd. A key concept here is the experiential factor. It means people want quick and easy results without waiting. In investing, this leads to buying at high prices and selling in panic. The author also introduces the law of the farm. Just like farming takes time, investing also requires patience. There are no shortcuts. The main takeaway is simple. Self discipline and emotional control matter more than intelligence. Now, moving to the next slide, market psychology and investor behavior. This chapter answers an important question. If stocks give high returns, why do investors still fail? Answer is behavior. Stock returns come from two sources: fundamental return and speculative return. Fundamental return comes from company growth. Speculative return depends on market sentiment. Even if a company performs well, returns can differ based on how investors feel about it. The author studied the BSE Sensex and found that companies grew steadily, but market returns were highly volatile. This volatility was caused by changes in investor emotions, not business performance. This leads to a key lesson. The price at which you buy a stock determines your return. Buying at high price, increasing risks, and buying at low price improves returns. Finally, there are two types of investors. Most people follow the crowd and react to news, leading to average results. A small group stays patient, thinks independently, and controls emotions. This path is emotionally difficult, but it leads to success. To conclude, investing is not just about knowledge, it is about discipline, patience, and controlling your emotions. I would like to hand over it to Chirag.
Thank you, Janesh. Now, let's begin with a powerful quote by Sir Warren Buffett. It is only when you combine sound intellect with emotional discipline that you get rational behavior. This perfectly summarizes behavioral finance. Here's the harsh reality truth highlighted by Sir Parag. Most investors underperform not because they lack intelligence, but because of their behavior. We are told markets are rational and efficient, but if that were true, why do bubble crash? Why do smart people make bad decisions? Because markets are driven by emotion, fear, and greed. And this leads to four common mistakes: loss inversion, herding, buying at peak, and panic selling. These feel natural, but in investing, what feels natural often leads to failure. The solution is value investing. Because of because in the end, biggest enemy of an investor is not the market, it is themselves. Moving to the next slide so we can fix this with a disciplined investment process. Let's look at the four major traps. First is flawed asset association. Many investors focus too much on safety like gold and cash, but often the long-term equity built real wealth. Second, instant gratification. We live in a fast world, but investing is not a T20 match, it's a test match. Third, loss inversion. We sell winners too early and hold on to losses for too long. Fourth, valuation. A low P/E ratio doesn't mean a stock is cheap. Sometimes it's a value trap. As Sir Parikh said, every growth stock has was once a value stock. Real investing is about value, not hype. Let's move to the next slide. Now, let's talk about consistent investing. A consistent investor does not against the crowd, but only when the crowd is wrong. Buy when others are fearful and sell when others are greedy. But this is not easy. Why? Because we naturally want to follow other. We believe recent trends will continue. We fear losses and we fear standing alone. A great example is VST Industries. When advertising bans hit the tobacco industry, investor panic. They sold and prices fell. But the investor thought differently. No ad means no new competition. While crowd saw fear, they saw opportunity. Let's move to the next slide. So, does this strategy actually work? Yes, and the results are clear. An 11-year study showed that rupees 1 lakh invested in the stock grew to nearly 6 lakh. But more importantly, the stock fell less during the market crash. Why? Because of the concept of margin of safety. Bad news is already priced in. As Sir Warren Buffett said, it is only when the tide go out that we know who has been swimming naked. In that case, VST investor not only gained capital but also earned division while waiting. As with that, I would like to pass it to Manas.
Well, thank you, Chirag, for such great insights. Now I would like to continue and explain you guys about growth trap. A common misconception in investing is that buying a good company automatically leads to good returns. In reality, investors frequently lose money not because they choose a bad business, but because they paid very high for a good business. Now let's understand how this happens. When a company demonstrates strong growth in revenues, profits, or market share, it naturally attracts attention. Investors become optimistic, and gradually this optimism turns into overconfidence. They begin to assume that this high growth will continue on for many years or for a long time. And as a result, the stock prices start rising. And not just based on the current performance, but on the basis of future expectations. Now, this is where the problem lies. No company can sustain such extraordinary growth indefinitely. And even a small deviation from such high expectations can lead to sharp correction in stock prices. And a good example of this behavior was seen in several technology and media stocks in India during the late 1990s and the early 2000s, where companies were priced extremely high depending on their future growth. When actual performance did not meet these expectations, stocks crashed significantly. And despite the businesses themselves not being that poor. So the key issue is not the quality of the company. It is a gap between the expectations and the reality. And this gap does not translate into a good investment. Now moving on to the next slide, I will be explaining you guys about commodity investing. Before we talk about how to invest in commodities, let's first understand why they behave so differently. Unlike normal businesses, commodity companies don't have control over prices. Their earnings keep going up and down, and everything depends on supply and demand. And because of this, commodities move in cycles. And if you look at this cycle, it usually starts with a boom. Prices are high, companies are making good profits, and everything looks great. But high prices attract more production, and more supply comes in. And this over leads to overcapacity. That leads to a price crash, and profits disappear, and the whole industry starts making losses. At this stage, weaker players or struggle or shut down, and supply reduces. And slowly the industry starts recovering again. So the cycle repeats itself. Now, here's the important part. The problem is not the cycle itself. The problem is how investors behave according to the cycle. Most people buy when things look the best, which is during the boom, and they sell when things look at their worst, which is during losses, which basically means they do the exact opposite of what they should be doing. So if most investors are getting this wrong, what should we be actually be doing? To answer this question, I would like to move to the next slide. Well, the answer is very simple. You have to think opposite to the crowd. Instead of buying when everything looks good, you buy when things look uncomfortable. Let's understand this better with the help of an example of sugar industry. So when sugar prices fall below cost, the entire industry starts making losses. News is negative, sentiments are weak, and most investors try to stay away from this industry. But this is where the opportunity is. Strong, low cost companies like Balrampur Chini Mills are able to survive this phase, while weaker players struggle or even exit. And as weaker players exit, we all know that supply reduces, and that eventually leads to a recovery in prices. So, the best time to invest is not when things look good, but when prices are low, the industry is under stress or struggling. And the key takeaway from this is that in commodities, it's about understanding the cycle and timing your entry. Thank you. Now I would like to hand it over to Devraj.
Thank you, Manas. So let us start with PSU investing. So PSU units, PSUs are important part of India's economy. They have played a vital role in building the nations. Over time, many of them have created strong and long-term wealth for the investors. However, most investor today focus on high growth sector and stocks for short-term gain, but often ignore PSUs even though they can offer stable and sustainable return. So now we discussed that what is the pessimistic view and optimistic view around the PSU investing. Let us start with pessimistic view. So first was government interference. In some sector like oil and gas, pricing decisions are influenced by the government. This can reduce profitability and affect the investor confidence. Second, policy risk. Since the government owns this company and decisions are not always purely based on business driven, political pressure and public expectation can lead to decisions that popular but not always profitable. Also, in coalition government, where multiple parties are involved in decision making, and it becomes the slower and complex, making it harder to take bold steps to divestment or privatization. Third is business cyclicality. Many PSU operate in sectors like oil, metals, and banking, which are the cyclical in nature. And because of this, they often get lower valuation compared to fast-growing sectors like AI and IT. Last is competitive resilience. Many PSUs were built in time where there was little competition. But today, industry like telecom and banking require speed, efficiency, flexibility. Government-owned companies sometimes struggle here, making them less competitive compared to private players. So let us discuss optimistic view about PSUs. First was PSU stocks are not market favorite. They are not fads and fancies of the market, but the lack of hype can be hidden opportunity. As their stocks are often undervalued for long-term investors. Second, PSU operates in very important sectors like banking, oil, power, mining, defense. But these sectors are uh, have high entry barriers and making it difficult for new player to enter. Third is PSU already build a large capacity and wide network. Over time, this gives them a strong advantage because it is very costly and time consuming for others to replicate the scale. Lastly is people believed PSU couldn't compete with private players, but they actually had a strong head start and were already well established before competition increased. So now we understand about the behavioral anomalies around PSUs. So next slide. So first is overconfidence bias. Investors believe their judgment is always there. They assume that PSU cannot compute globally. Government interference, harm, and then so they avoid this talk. Second is representativeness. Investors generalize all PSUs are slow, low growth, and companies just because the government is owning the companies. Okay, so this create a negative perceptions for the entire sector. Loss aversions. Investors feel losses more strongly than gains. Since government policies price are controlled have affected PSU profit in the past, and the investor become more cautious and avoid them. Fourth was the availability bias. The PSU do not get much media coverage. Third, also, uh, PSU do not get much media coverage analysts and don't track them closely, and broker don't promote them. So investor don't hear much positive about them, and they stay out of focus. So now I discussed fourth point, which is confirmation bias. Early was third. So investor focus only on negative example like MTNL and Indian Airways. Now, while ignoring successful PSUs like Indian Oil, Bharat Electronics, BHEL, and SBI, so which have significantly performed well over the years. So I want to give the conclusion about PSUs that it's not about just fundamental, but investor psychology keep people away from PSU stocks. So now I would like to hand it over to my colleague Tisha to continue with the sector investing decision.
Thank you, Devraj. Let us first understand the major behavioral biases. So the first one is winner's curse. It happens when investors overpay for popular stocks due to high competition and excitement. The second is confirmation bias. It is when investors only look for information that supports their beliefs and ignore risk. The third is anchoring bias. It is when investors get stuck on past prices and fail to adjust to new information. Next is representativeness bias. It means when investors believe that the recent performance is good and will continue in future. For example, if a sector performs well, people assume it will keep growing. The next is availability bias. It means investor depends on easily available information like news or trends rather than a deep analysis. And finally, the herd mentality is when investors simply follow crowd without thinking independently. This leads to creation of bubbles because everybody is buying the same thing. Now, moving on to the next slide, we have a sector analysis. The books explain how different sectors behave differently. The first is banking sector. This sector has grown due to capital expansion, but private banks trade at higher valuation due to expectation. The second is the capital goods sector. It has shown strong return aligned with economic growth. The third is IT sector. It has matured after the 2000 bubble, and despite challenges like currency appreciation, it offers a long-term opportunity. The fourth is the metal sector. It is highly cyclical with huge returns but also high risk due to sharp decline in prices. Now, moving on to the next slide. Moving on to the next slide, we have oil and gas sector. It is heavily dependent on the global factors and are quite volatile. The next up, we have two sectors which are healthcare and FMCG. These are defensive sectors, stable, less risky, often undervalued. Last but not the least, we have real estate and power infrastructure sector. These are the hot sectors during boom, attracting excessive attention and leading to overvaluation. Thank you. I would like to hand over the stage to Deep.
Thank you. Good afternoon. My name is Deep, and today I'll briefly talk about IPOs, initial public offerings, and how we should think about them as investors. Whenever a new IPO comes into the market, there's always excitement. This is what we call the lure of the new. People People are naturally attracted to fresh opportunities, and often the hype goes beyond what the fundamentals justify. In India, the IPO market has grown significantly in recent years. We have seen strong retail participation and a steady pipeline of companies coming to the market. However, not all IPOs are equal. Some are high quality businesses, while others may be overpriced or not so fundamentally strong. From an economic perspective, an IPO benefits multiple parties. The company raises capital, gains uh, the company raises capital and gains visibility. Investment bankers earn fees, and early investors may exit. But for new investors, value creation is not guaranteed. This is also important to understand who takes the first risk, typically institutional and anchor investors. They set the tone for how the IPO performs initially. But the biggest challenge comes from our own psychology. Many investors fall into traps like FOMO, herd behavior, and overconfidence. We tend to assume that new means good, or that listening gains are easy money. These are mental shortcuts or heuristics that can lead to poor decisions. So, how should we approach IPOs? We need to remember an IPO are not lottery tickets. The success of an investment depends on business quality, valuations, governance, and long term fundamentals. The key takeaway is simple: look beyond the hype, evaluate the business, understand the price you're paying, and invest with clarity, not emotions. Now, let's shift to the next slide. Index investing, completely different approach to the market. At its core, index investing is about understanding that markets move in cycles. In the short term, there are disruptions and uncertainty, but over the long term, markets tend to grow. This balance between continuity and discontinuity is key. If we look at stock market behavior, prices can be very unpredictable in the short run due to emotions and news. But over time, fundamentals like earnings and growth drive returns. This is where index investing becomes powerful. Index investing is a passive strategy where you simply invest in a market index like the Nifty 50 or Sensex. Instead of trying to pick winners, you own the entire market. Why do many investors prefer this approach? Because it's low cost, well diversified, transparent, and easy to manage. You don't need to constantly track or time the market. Interestingly, data shows that most active fund managers fail to consistently beat the market over the long run. This suggests that a simple, disciplined strategy often works better than complex ones. So, what are the lessons for us as investors? Focus on what you can control: cost, diversification, time horizon, and most importantly, your behavior. Stay patient and let compounding do its job. The key takeaway here is you don't need to beat the market. You just need to stay invested and own the market. Thank you. Now, Aryan will represent.
Thank you, Deep here. Now let's first understand how a bubble is formed. Okay. So instead of just looking at the theory, let's get rather real. It usually starts with something that genuinely makes sense. A new opportunity, a growing sector, or a strong business story. At this stage, investments are actually reasonable. Then early investors enter and start making profits. When others see this, attention builds. Now comes the turning point. More and more people join in, not because they understand the value, but rather because they don't want to miss out. This fear of missing out slowly takes over. As the prices keep rising, not because of value, but because of the rising same pace, it is mainly due to demand. And that is when the valuations stop making sense. Hence, the high price to earnings ratio. Then the optimism becomes extreme. You'll see constant positive news, strong narratives, and overconfidence about the stocks and the sector. Some investors even start taking extra risk just for those extra profits. But this kind of growth is not sustainable. So, when a small negative trigger kicks in, confidence breaks quickly. The same people who were earlier rushing for profits are now rushing to sell. Moving on to the next slide. Now let's get a hold on what is not to be done. So based on this, what is to be avoided? First, do not follow the crowd. Just because everyone is buying something doesn't mean it's always right. Second, don't just buy because the prices are going up. Rising prices create excitement, not value. Third, do not ignore valuation. I repeat, do not ignore valuation. This is critical. Even a great company can give poor returns if you overpay. Fourth, avoid using leverage in hot markets. Borrowing money when things are already overheated increases your risks a lot. And finally, do not confuse a good company with a good investment, as Manas said. What really determines your returns is the prices you pay, and acquisition price and valuations drive your returns. Moving on to the next slide. Now let's talk about action-oriented investing. What should we do instead? We should follow a sort of a more disciplined, action-oriented approach. Firstly, focus on the intrinsic value. Invest based on what something is actually worth, not what the market is actually saying. Second, do not let greed and fear drive your decisions. Markets will move, but reacting emotionally leads to mistakes. Third, rely on data and analysis, not just trend and tips. Fourth, avoid herd mentality. Independent thinking is very important. Fifth, take a long term approach and ignore short term noise and let compounding do the work. And most importantly, avoid panic reactions. Most investors buy high in excitement and sell low in fear. Exactly the opposite of what should be done. To conclude, the main key takeaway is that market themselves are the real problems. Investor behavior is. Most mistakes don't just happen due to lack of knowledge, but rather due to lack of discipline. If we can control our emotions and avoid common traps like FOMO and overvaluation and stay focused on long-term value, we can make much better decisions. Thank you.